Markets occasionally have some impressive swings. A big price move up or down generates feedback loops as both market participants and policymakers respond. Then the storyline changes again and yet again. The key to understanding market volatility is to appreciate that it is about the narrative, and that the narrative is rapidly evolving as we sort through an irregular stream of news and noise. The School of Narrative Economics, led by Nobel Prize winner Robert Shiller, argues that expectations are grounded in the stories that people are willing to internalize, to believe, to repeat to others, and to post on social media. Traditional media tracks social media and accelerates the adoption of the narrative. For what truly matters to market participants and to appreciate the underlying catalyst for market volatility, one needs to monitor the shifts in the narratives that markets are following. In addition, and to complicate things, compelling narratives often shift gears and may well generate sub-narratives that focus on different parts of the storyline. Take the evolution of the COVID-19 virus narrative. The story first hit the news media on January 21, 2020. Oil markets responded quickly, down about 10% over the next few weeks, while during the same period equities, as measured by the U.S. S&P 500 index, equities actually drifted slightly higher. Oil was first hit because the narrative was all about China, and China is a huge importer of oil. The weekend, February 23-24 of 2020, saw a major shift in the narrative, from a China-only story to a global story. Equities took notice of the shift in the narrative. Over the next 10 days, the U.S. S&P 500 fell over 10%, and oil continued its slide into bear market territory. A sub-narrative developed on March 4, 2020, when the Federal Reserve made an emergency cut in rates. The Fed was well aware that a cut in rates would have no impact on the spread of COVID-19, but it was becoming apparent from stock prices that many companies would suffer revenue declines. The Fed opted to move early and to do whatever it could. The narrative, however, shifted to wondering if the central bank toolkit would be effective for this type of economic event, and equities declined further. The weekend of March 7 and 8, 2020 brought another shift in the narrative, a splinter into a sub-narrative of critical importance. Saudi Arabia asked Russia to help cut production to stem the decline in oil prices. Russia did not agree. Saudi Arabia responded with a U-turn relative to market expectations and announced it was cutting prices and expanding, not cutting, expanding production. The reaction when markets opened on Monday, March 9, was that the altered narrative created intense selling pressure in both oil and equities, and with spillovers into foreign exchange. Countries importing energy, such as Japan, saw their currencies rise, while exporters such as Russia saw large currency depreciation. Narratives will have many twists and turns before they fade, and more volatility in response. What is key to understand is that in times of stress, the changing narrative is going to be much more critical to appreciating market volatility and market reactions than tracking lagging economic data. The data will eventually catch up, but market participants cannot wait that long to manage their risks. As the storyline changes with the news, markets respond quickly and sometimes abruptly. I'm Blue Putnam, Chief Economist, CME Group.